Welcome to the deep dive. We are going straight into the heart of corporate filings today. We're looking at Vaibhav Global Ltd,
Yeah.
VGL, the big global e-tailer, famous for fashion jewelry, lifestyle goods, really deep value. And our mission today is pretty clear. Unpack the results of their latest board meeting and those Q2 financial filings. That's for the quarter ending September 30th, 2025. It's not just reading numbers, right?
No.
We want to understand the engine driving them.
Exactly. And it's a fascinating engine because VGL runs this kind of hybrid model. They've got their own TV channels, Shop LC in the US, Shop TJC in the UK, things like that, plus these really strong digital platforms.
Bypassing traditional retail.
Totally. Gives them direct access to, around 127 million households globally. It's impressive. But here's the core tension we need to explore today. VGL smashed it on profitability this quarter. Huge acceleration.
Right.
But at the same time, they actually trimmed some key marketing costs. So the big question is, can they keep up that aggressive growth and that deep cost optimization simultaneously? Is that sustainable?
That is the central question. So we're breaking it down for you into three main areas. First, the financials' surprisingly strong growth, and we'll get into the mechanics of how their margins expanded. Second, the operational side. Customer metrics, retention, how they're pushing their own brands, that's crucial.
That's the engine room stuff.
Exactly. And finally, we do need to look at the strategic management changes and, the necessary legal and ESG updates. Okay, let's unpack this. Right. Section 1, the quarterly scorecard. Let's hit the headlines. Q2 FY26 revenue, 877 crores.
Which is about, 105 million US dollars?
Yeah, roughly. And that's up 10.2% compared to the same time last year. What's interesting right off the bat is that this number actually beat their own guidance.
Right. But, the real story here isn't just the top line. It's where that money actually ended up. This was efficient growth. You look at profit after tax PT, the real bottom line profit, it saw this massive 71% jump year over year, hit ours, 48 crores.
71%.
Wow. Okay, that immediately makes you ask, is that sustainable? Or is it some kind of one-time adjustment?
Well, looking at the details, it seems more structural. Take EBITDA earnings before interest, taxes, depreciation, and amortization, sort of the gauge of operating health. That was up 28% year over year. And crucially, their margins expanded by 130 basis points. They hit a pretty healthy 10% EBITDA margin.
Okay, 130 basis points, just for everyone listening, that's a 1.3 percentage point increase in margin. That's quite a jump in retail, isn't it?
It really is. It's significant.
So that margin expansion is what we need to dig into. What specific things drove that 1.3-point jump? Was it just, cutting costs everywhere or something more targeted?
They actually lay it out pretty clearly in what they call the EBITDA margin walk. It's basically a forensic breakdown showing exactly where the efficiencies came from. And it suggests, smart management, not just frantic slashing. For instance, operational efficiencies in shipping cost. That only added about 0.3% relative increase compared to revenue. Airtime costs were also kept in check, up just 0.4%.
I did notice they highlighted productivity improvements in employee costs, contributing, 1.6% relative for revenue?
Which suggests VGL is, getting more out of its current workforce. That's operating leverage right there.
Right.
But here's the really interesting part, circling back to that tension we mentioned. They actually decreased digital marketing spend by 1.1%.
While digital revenue was growing.
Precisely. While digital revenue was accelerating, that's kind of the definition of efficiency, isn't it? Spending less to get the same or even more revenue. So you add all these factors up, and that's how they got to that 10% EBITDA margin.
Yeah, it really paints a picture of a company with, pretty disciplined control over spending. And you see that flowing right through to the balance sheet. They're reporting strong capital strength, a net cash position of 156 crores. And their efficiency ratios look good too. Return on capital employed, ROCE, is at 20%. Return on equity, ROE, is 13%. Those numbers basically tell you they're using their money very effectively to make more money.
And that financial strength, it translates directly into rewarding shareholders, building confidence. The board declared a second interim dividend, ROF, 1.50 per share, which brings the total interim dividend declared so far this period to RS 3.00 per share. And for anyone holding the stock, the date to be on the books for that payment, the record date, is Thursday, November 6th, 2025.
Okay, those financials look pretty solid. But, numbers tell us where they've been. To figure out where VGL might be going, we need to look under the hood at the engine, the customers, and this is where that channel mix gets really interesting.
Yeah, absolutely. The first metric that just jumps right out is the unique customer base. Over the last 12 months, the trailing 12 months, or TTM, they hit an all-time high, 714,000 unique customers.
Wow.
That's a 5% increase from last year. But what's maybe even more impressive is how, well, sticky these buyers are.
We're talking value jewelry lifestyle stuff here.
Yeah.
What does sticky actually mean for VGL? What does that look like?
It boils down to retention and frequency. VGL kept its customer retention rate steady at 41%. Now, for a retailer selling discretionary items, value jewelry, keeping over 40% of your customers coming back, that's incredibly high.
Yeah, that's tough to do.
It really signals they've built trust, maybe habit. It's much harder than just offering the lowest price. And not only are they retaining them, but those customers are buying more. The repeat purchase average is 22 pieces per customer over the last 12 months.
22 pieces.
Yeah.
Okay, that consistency sort of confirms what you said earlier, doesn't it?
Yeah.
That cutting digital marketing spend isn't necessarily a huge risk for them right now. It might actually be proof of strong loyalty, organic demand.
Could be.
Now, how are they reaching these customers? There's definitely a shift happening towards digital, right? Digital revenue is now 42% of their B2C revenue.
Yeah, and the growth numbers really confirm that shift. Digital revenue was up 14.3% year over year. Compare that to TV revenue growth, which was 6.7%. So digital's growing much faster.
Okay, but does that raise a potential red flag? Is VGL maybe cannibalizing its, presumably quite profitable TV business just to chase digital sales, which might have lower margins? Or are they managing this transition carefully?
That's the critical question, isn't it? The data we have suggests it's being managed, and I think the key reason is their simultaneous push into owned brands.
Okay.
The strategy there is all about control and protecting those margins. In-house brands made up 41% of their gross B2C revenue this quarter, Q2 FY26.
And that's up
sharply from 31% just a year ago. And they've got this explicit, pretty aggressive target to get that number close to 50%, half of their gross B2C sales from those in-house brands by fiscal year 27.
Right. And when you own the brands.
Exactly. You control the supply chain, the quality, and critically, the margin, which is absolutely key to supporting that 10% EBITDA margin we were talking about earlier.
Makes sense. That ownership gives them a bit of a buffer against supply chain issues, too. Just quickly touching on the regional breakdown. The U.S. is still the anchor, right? U.S. TV revenue was Rs 487 crores. Digital followed at Rs 336 crores. And we should probably mention their B2B segment, too.
Yeah, the business-to-business side brought in Rs 54 crores, showed pretty strong growth, actually 17.3% compared to last year.
Okay, good context.
Now, shifting gears a bit to strategic management moves, the board made a designation that I think signals something important about their focus on internal culture as like a competitive advantage. They designated Mr. Sabaresh Kumar, he's the Group Chief Human Resources Officer, the CHRO, as Senior Management Personnel, or SMP. That was effective late October 2025.
Okay, why is elevating the CHRO to that specific SMP designation significant right now? What does that signal?
Well, it's a very modern kind of move, isn't it? It basically puts human capital planning on the same strategic level as, say, financial or operational planning. Mr. Kumar has, over 24 years of experience?
Yeah, specializing in inclusive cultures, leadership development, transforming organizations globally.
Right. So it really signifies that VGL gets it. They understand that maintaining efficiency and scaling globally needs a strong, resilient, inclusive internal culture. If they're getting that productivity leverage from employee costs we mentioned, then the CHRO's role becomes absolutely central to keeping that going without, burning out the team.
Makes sense. Let's turn now to the newer markets, the acquired ones.
Yeah.
These are kind of the incubators for future growth, aren't they?
They are, and they're showing some clear, positive steps towards profitability. Take Germany, for example, operating as Shop LC GmbH. Their Q2 revenue was euro 6.4 million.
Okay.
And the group there saw a better product mix, better pricing discipline, which expanded their gross margins by a huge 410 basis points.
Oh, 4.1 percentage point.
Yeah, massive jump in the first half of the fiscal year. So the goal there is pretty clear now. They're aiming to make the German operation EBITDA positive in this current fiscal year, FY26.
Okay. Ambitious, but seems achievable with that margin improvement.
Yeah.
What about the UK? Ideal world.
Ideal World, the UK acquisition, yeah. They actually maintained EBITDA profitability during Q2. Revenue was 6.1 million, so consistent profitability there, which is key for any new market integration.
Definitely.
And finally, Mindful Souls over in the US, they posted Q2 revenue of $3.4 million. Now, what's interesting here is you can see VGL making strategic choices. They improved gross margins significantly, hit over 73%.
73% plus. That's high.
Very high.
Wow.
And they sustained profitability even though revenue took a little dip. But that dip wasn't an accident. It was driven by intentionally changing the product mix and, again, strategically pulling back on marketing spend.
So they chose margin over just chasing the top-line revenue number.
Exactly, which lines up perfectly with that overall 71% PAT increase we saw for the whole company, doesn't it? It's about profitable growth.
Right. It all connects back. Okay, moving beyond the financials and operations, VGL consistently emphasizes its social commitment. That's pretty central to their brand, seems like.
It does seem to be.
Their flagship midday meal program, Your Purchase Feeds. Incredible numbers here. They've now served over 106 million meals since they started it.
106 million. That's staggering.
It really is. And they're maintaining a run rate of providing about 55,000 meals every single school day.
And that focus on, governance and social responsibility gets recognized externally, too. VGL improved its ICRA ESG score. It's now 73, strong. And they earned that Great Place to Work certification globally.
Right.
And look, these aren't just feel-good metrics, are they? They signal lower turnover risk, greater internal stability, which actually supports those productivity gains we talked about back in Section 1.
Good point. It all ties together. Now, for completeness, because, a proper deep dive has to look at potential risks too, we do need to touch on the ongoing legal matters mentioned in the filings, specifically these multi-year tax disputes.
Yes, this is an important detail to note. There are ongoing tax proceedings with the Income Tax Department in India. These stem from a survey that happened back in 2021, and they cover assessment years right up to 2022-23. On top of that, the department has filed something called a special leave petition, an SLP, with the Supreme Court of India.
Okay, an SLP. For listeners maybe not familiar with the Indian legal system, what exactly does that signify?
An SLP is basically asking the Supreme Court for special permission to appeal a lower court's decision. In this specific case, the SLP is challenging earlier high court orders that had actually quashed or nullified reassessment proceedings for 4 specific assessment years, 2012-13 all the way through 2015-16. So yeah, it's a complex multi-year dispute.
Okay, so even if management feels confident, having a multi-year legal issue, especially one that's gone all the way up to the Supreme Court, that suggests a potential overhang, doesn't it? Why is that 2021 survey still dragging on? And what are the implications of this persistent tax risk?
Well, the fact that proceedings from a 2021 survey are still ongoing definitely points to complexity and, resource allocation, management time, legal fees, they get diverted to dealing with these things. Now, management's position is clear in the filings.
Right.
They state that based on the nature of the matter, the legal merits and opinions they've sought externally, they do not expect any liability to actually arise from these proceedings.
Okay.
But, for anyone looking at the company, you have to recognize the administrative burden and maybe factor in a small potential risk premium associated with this kind of persistent tax litigation. It's just, part of the cost of doing business, even for a company with strong governance ratings otherwise.
Understood. Okay, let's wrap this up then. To summarize this whole deep dive for you, VGL seems to be really mastering profitable scaling right now. That huge 71% jump in profit after tax wasn't just luck. It was driven by specific, almost surgical cost controls and getting more leverage, not just broad cuts. They seem to be managing the shift to digital pretty effectively, driving sales through those increasingly important in-house brands, and maintaining that really impressive social impact footprint with the Meals program.
And looking ahead, management is sticking firmly to its guidance for the full fiscal year 2026. They're projecting 7-9% revenue growth for the whole year.
Okay.
They seem pretty confident that if macro conditions stabilize a bit, maybe tariff concerns ease, there could even be some potential upside to that. And their strategic commitment seems really clear. Using emerging tech, including AI, to improve customer engagement and boost productivity further.
So what does this all mean for you, the listener?
Well, it looks like VGL is strategically focused on going deeper with its existing customers, moving beyond just acquiring new ones, focusing on retention, getting a larger share of their wallet. And they're doing it through better internal productivity and strong brand control. It's really a story of internal efficiency driving those external results we saw.
Yeah, and considering VGL is explicitly saying they're investing heavily in emerging tech like AI to boost that customer engagement, here's something to think about. How might their vertical integration, I mean, they do everything from actually manufacturing jewelry in Jaipur, India, all the way through to delivering it globally via digital channels. How could that entire chain be dramatically optimized by AI? Could that level of tech integration potentially set a completely new benchmark for speed, for customization in this value retail space? Could it make even their current pretty impressive 41% attention rate look low in the future? That's maybe the question to take away as you watch this space.